Think investing is only for Wall Street elites? Tell that to the 11-year-old who became a billionaire and did it without chasing hype or meme stocks. This isn't just a story about Warren Buffett. It's a playbook for anyone sick of being broke and ready to build a portfolio that pays you while you sleep. In this video, we're going to break down dividend investing, Buffett style, so you can start collecting those sweet, steady paychecks without becoming a day trading zombie. You're watching MCubed Money Mindset Makeover, where we crush old money myths and rebuild your financial confidence from the ground up. If you're tired of feeling broke in a system built for the rich, hit that subscribe button. Let's flip the script, starting right now. Buffett didn't get rich because he was flashy. He got rich by doing the opposite of what broke people do. He invested in stable companies that pay him over and over again for simply owning a slice of the business. That's called dividend investing, and it's the move. Imagine getting paid quarterly just for being smart enough to own a piece of Coca-Cola, Apple, or Johnson & Johnson. That's the quiet flex that built Buffett's empire. Quick crash course. A dividend is a payout a company gives its shareholders, aka you, just for owning stock. It's real cash, like hits your account and you can buy groceries with it kind of cash. Buffett buys companies that consistently pay and increase those dividends. Over time, it turns into a waterfall of wealth. Think of it like planting a money tree that rains dollar bills every quarter. How to find these cash-spitting machines? Step 1. Look for companies with a history of steady or increasing dividends. No sketchy startups. No FOMO-fueled crypto pumps. We're talking big dogs. Companies that survive recessions, tech trends, and TikTok panic. Check for dividend yield. In other words, how much they pay relative to their stock price, payout history. Consistency is key. Financial strength. Are they drowning in debt or swimming in profits? Buffett does not gamble, neither should you. You want a portfolio that throws off cash. Reliable, boring, and beautiful. These are your passive income soldiers. Think companies like Johnson & Johnson, Procter & Gamble, PepsiCo, Microsoft. They don't just survive, they pay you to watch them grow. Over time, these small checks become bigger checks. And those checks? They start to stack. Key takeaway number 1. Avoiding shiny object syndrome. Here's where most beginners mess up. They chase hype stocks. Hot tip. If it's trending on TikTok or Reddit and you're seeing emojis, it's probably already too late. Buffett says, be fearful when others are greedy, and greedy when others are fearful. Translation? Buy smart, not loud. Forget meme stocks and influencer advice. Focus on companies that pay you, not play you. Key takeaway number 2, think long-term. This isn't crypto roulette. This is a slow burn strategy. Buffett started investing at 11 and didn't become a billionaire until his 50s. His weapon? Time. Companies like Coca-Cola have increased their dividends for 50-plus straight years. They're not sexy, they're reliable. And in this game, reliable equals rich. Stay in the market. Let compounding do its work. In 5 years, your money will thank you. Key takeaway number 3, diversification is your armor. Would you bet your entire paycheck on one lottery number? No? Then don't do it with your portfolio. Diversification is your armor against market mayhem and is the golden rule of any successful investor. Spread your investments across tech, healthcare, consumer staples, utilities, big companies, small companies, domestic and international. When one sector tanks, another can balance you out, and your overall returns remain relatively stable. This is how you survive volatility, with range, not risk. Key takeaway number 4, rebalancing equals maintenance mode. Let's say you buy a bunch of great companies. One of them pops and takes over 40% of your portfolio. That's cool until it crashes. Rebalancing means you check your portfolio every few months and adjust your holdings to keep things steady. It's like taking your car in for a tune-up. Boring, maybe necessary, absolutely. But just like any machine, it needs occasional maintenance to keep it running smoothly. Over time, market fluctuations can cause the weightings of your investments to shift. For example, if a company in your portfolio experiences a significant price increase, it might start to take up a larger portion of your portfolio than you originally intended. This is where rebalancing comes in. Periodically evaluate your portfolio's asset allocation and make adjustments if needed. This might involve buying more shares of underperforming companies or selling some of the overachievers to maintain your desired risk profile. Rebalancing helps ensure your portfolio stays aligned with your long-term goals and prevents any one investment from having an outsized influence. If this makes sense, maybe even if it doesn't, be sure to hit that subscribe button and join the Money Mindset Makeover crew. Future you will thank you. Key takeaway number 5, drip your way to wealth. DRIP stands for Dividend Reinvestment Plan. It means when you get a dividend check, instead of cashing out, you automatically reinvest it into buying more shares. More shares equals more dividends. More dividends equals more shares. It's a financial feedback loop. This might seem like a small drop in the bucket at first, but over time the power of compounding kicks in. Each reinvested dividend buys you more shares, which in turn generate even more dividends, creating a snowball effect that accelerates your wealth creation. It's like turning on a faucet of free money and letting it flood your future. Let's recap. Warren's style: to invest like Buffett. Buy quality companies that pay dividends. Think long-term, years, not days. Diversify so you're not exposed. Rebalance when needed. Drip to grow that snowball faster. This is how you build real wealth, without being glued to the stock ticker or chasing the next hype coin. Remember, this is a marathon, not a sprint. Don't get discouraged by short-term market fluctuations. Stay focused on the long-term potential of your dividend-paying companies. Let's talk mindset, the true secret. Here's what nobody tells you. You don't need a finance degree to build wealth. You need curiosity, consistency, and patience. Buffett's not smarter than you. He has had some phenomenal breaks and optimized on opportunities through his years of investing, but he just plays the long game well, and now you can too. You don't need $1 million. You need the right system and the discipline to stick with it. That's what MCubed is all about. It's not about chasing. It's about choosing wisely and letting time do the work. Bonus wisdom: Buffett-approved habits. Let's wrap with a few habits that separate wealthy investors from broke ones. Learn before you leap. Research companies. Read earnings reports. Research their financial health, competitive advantages, and future growth prospects. Know what you're buying. Don't invest in hype, invest in reality. Don't panic when the market dips. Corrections happen. Recessions come. But smart investors stay calm, buy more, and ride it out. Remember, patience and a long-term perspective are your greatest allies in dividend investing. Celebrate small wins. Your first $10 in dividends? That's proof it works. Celebrate it. Then reinvest and keep going. This growing income stream can help you achieve your financial goals, whether it's an early retirement, a dream vacation, or simply having a financial safety net. You don't have to stay broke, stressed, or in survival mode. You can build a portfolio that pays you, just like Buffett did. It starts with a single decision. Buy smart, not fast. Hold long, not loud. Because true wealth isn't built in the noise of trends, but in the quiet patience of strategy, discipline, and vision when no one else is watching. Hit subscribe so you don't miss our next video. My honest advice on the golden rules of money. It might just save you from wasting months. Happy investing, and may your dividend checks keep flowing.